Hi, it's Tuesday, the 7th of July. I'm David Fife, Chief Economist for Argus Media. I'm here with some colleagues from the Argus Analytics and Consulting team, and we're going to give you a bit of an update on the state of play in terms of the different commodity markets covering oil, gas, and fertilizers from the crisis in the Strait of Hormuz. We're 4 months in. And we're going to give you a little bit of an update on what's going on and what may lay down the road in terms of developments to come. So I'm going to allow each of my colleagues in turn to introduce themselves.
Hi, David Luff. I'm a senior manager within the gas and LNG analytics team.
Good morning, everyone. My name is Marina Simonova. I'm head of fertilizer analytics at Argus.
And I'm Martha Tallis. I'm a senior manager in the analytics department covering crude oil.
Thank you, everyone, for being with us. Just a word to say that this today's update is a bit of a precursor for some deep dives that we're going to do sequentially over the weeks ahead in oil, gas, and fertilizers in terms of the state of play for each of the individual markets. Before we start to hear from our subject matter experts, just a couple of introductory words from me that accompany some of the slides that you can maybe see on your screen. The key issue here for the market, of course, is essentially the closure of the Strait of Hormuz. Really, since the conflict began at the very end of February, we've seen a real restriction of flows and vessels going into and out of the Middle Eastern Gulf. And that has affected not only oil. I mean, the popular press have very much suggested that this was overwhelmingly an oil issue, but of course it's affected flows of really all commodities out of and into the Middle Eastern Gulf. 20 to 30% of global flows of oil and gas have been affected. Similarly, around 27% of globally traded LPG has been impeded by the crisis. But then you look at markets such as fertilizers, and between 35 and 50% of globally traded supplies have been affected, and things like aluminium and grain markets also have been affected. A lot of the commodities coming out of the Gulf were destined for markets in the Asia Pacific. So it's very much been the Asia Pacific market that has felt the impact to the greatest extent. And really the question going forward, now that we have a memorandum of understanding between Washington and Tehran, that at least on paper suggests that we'll see a reopening of maritime flows through the Gulf. Is how sustainable is that? How solid are the agreements between Iran and the US in terms of reopening flows to the global market? And that's something we'll try and examine in our discussion. Now, when we look at sort of what we expect for flows going forward, there's a chart here generated by the oil analytics team, which essentially says that we're working on an assumption that flows return to sort of 80% of their pre-crisis levels by the tail end of the year, and pretty much back to pre-crisis flows by the first quarter of 2027. That's a working assumption. And we'll drill down a little bit into whether that looks feasible across the commodity complex going forward. And a lot, as I said, will depend particularly on Iran's plan to charge maritime service fees going forward. The memorandum of understanding runs through until the second half of August. And during that period, Iran has pledged to allow the free movement of commercial vessels through the strait. But what's going to happen after the 17th of August? Is Iran really going to try and impose fees on ships moving through the strait after that, and what will that mean for commodity flows going forward? In terms of the impact that we've seen on both financial markets and commodity markets over the last 4 months or so, certainly the safe haven asset of choice, perhaps surprisingly, has been the US dollar. That has strengthened really fairly consistently through the crisis. To a lesser extent, the Swiss franc also. Gold and treasuries or bonds have been much less strong. That's partly because of some of the inflationary implications of the crisis and an expectation that central banks may need to raise interest rates going forward to control some of those inflationary pressures going forward. Equity markets have been a little bit more schizophrenic. To begin with, we saw 10 to 15% declines in equity markets, particularly the emerging markets. But more recently, we've seen a rebound in equity markets, partly because of strong first quarter results, but also because of a resilient flow of cash into AI and technology stocks. And the big question is, if we're going to see higher interest rates going forward, how sustainable is that strength in equity markets going forward? And then, just before I close and hand over to our subject matter experts, what have we actually seen in terms of commodity prices? Essentially, strength, 2.5-fold increases in commodity prices in March and early April. But really, since then, we've seen prices start to recede as expectations built that we could see a reopening of the Strait of Hormuz going forward. Now, what is going to happen in the weeks and months ahead? That's something we're going to try and touch upon. But I think what's been very interesting to see is the extent to which price spikes were fairly limited in duration and extent, and the degree to which prices have eased. And we're going to try and dig into some of the reasons as to why price spikes were relatively short duration for most commodities over this period. And I think I'm going to start by asking, beginning perhaps with Martha on the oil side, really, as I said, we saw spikes in prices for Dubai, for North Sea dated, for jet fuel, for diesel, but prices have fallen back quite sharply. So I guess my initial question to you is, physically speaking, how has the oil market dealt with this supply disruption from the Strait of Hormuz?
Mhm. Well, yes, the initial reaction that helped to some extent was, of course, the bypass pipelines to Yanbu and Fujairah. There were doubts about how high the utilization of these bypass routes would be, but they have performed very, very well. And so they have helped to a great extent. But then the two key factors that have helped the spike to be relatively short-lived has been the astonishing amount to which Chinese crude imports have gone down to a 9-year low, actually, as of May data, and also the SPR releases that the IA has coordinated. Most importantly being, of course, the US SPR releases, which have been at a pace of more than 1 million barrels per day. And of course, that translated to very high US crude exports, either of actual SPR barrels or other barrels that were displaced by US Gulf Coast refiners using the SPR volumes. And then, of course, there has been some demand contraction in certain regions and countries. Just the sheer shortage of LPG and naphtha just translated into lower LPG consumption in places like India, or lower naphtha consumption in Japan and South Korea. So there's definitely been some demand contraction. I wouldn't call it distraction, as some people have been calling it, because it will come back. But yes, all these factors, with China and the SPR release being the most significant, have definitely helped the spike to be short-lived.
So several enablers of a receding of the spike in prices, and we can touch upon some of the issues around demand destruction maybe later on when we take a look ahead. David, I mean, how does that compare with what you've seen in international gas markets, whether it's LNG or pipeline gas? What have been some of the sort of offsets that we've seen to the disruption of flows through the strait?
So, as you mentioned in your introduction, Asian buyers have been the most heavily impacted. So, across China, India, South Korea, Taiwan, Pakistan, and Bangladesh, they account for about 50 million tons of what was Qatar's kind of 77 million ton per year capacity. So, across those countries, they've been faced with a decision as to whether to replace cargoes, to switch to alternative fuels, or to constrain demand. And what we've seen across those countries and others is a range of those actions. So across Taiwan and Bangladesh, we did see replacement of cargoes. But then in China, South Korea, and Japan, we've certainly seen a switch more to coal, more of a reliance on stocks. So in South Korea and Japan, there's been a relaxing of the emissions restrictions that's set at present to last until the end of the winter, and yeah, that's helped to support coal burn across the second quarter, potentially also through the third quarter as well of this year. Then in Pakistan and India, we've seen initially at least more demand restraint. So in aggregation, by mid-April, we're at a situation where European demand across Asia is around about 3.5 million tons down on the year. So that balanced against a loss of Middle Eastern supply of kind of 6.5 to 7 million tons. So that really huge scaling back of demand, switching to commodities like coal, it did help to account for quite a significant proportion of the supply loss. On the other side of things, on the supply side, in February, global liquefaction utilization rates were already very high. So there's limited scope for those rates to increase. But what we had been expecting for this summer is that we'd start to see a situation of additional supply enabling prices to retreat across Europe. But what we have seen is, excluding Mideast Gulf supply, around about 4 million tons of additional supply, largely out of the US, Canada, but also ramping up of output from Nigeria, higher supply from Malaysia, and a number of sort of small additions elsewhere. Those combined really meant that the impact on Europe initially was actually quite limited. We then saw the prices fall back. And with that, I think the uncertainty as to the duration of how long the crisis may last, we have in more recent weeks seen that restraint really start to reverse. So if we look over the last sort of 4 weeks, we're now in a situation where demand outside of Europe is around 2.5 million tons up on the year now. So Europe's now starting to really sort of see the reduction, but largely kind of a collective scaling back of demand has helped the situation.
Okay. I think it's quite interesting, both for oil and gas, and that coming into 2026, there was an expectation that these were markets that were going to be relatively well supplied, plenty of non-OPEC supply growth, an expectation of the perpetual expectation of a wave of new LNG capacity, whether it's real or not. The expectation was there was going to be incremental US cargoes available this year. So to some extent, that's been one element sort of helping to offset this loss of supply that we've seen out of the Middle East Gulf. Of course, it doesn't cover the entirety of the loss, but I think there's a common thread there for oil and gas that we were expecting. Marina, when we think about fertilizers, to what extent has the situation been similar, offsets from both the supply and the demand side? What would you say?
We had some similarities, but I'd like to remind everyone that fertilizers play an important role in crop production and agribusiness value chain and food security ultimately. So I guess our value chain is connected on the upstream to both oil and gas on the one hand, and that's especially relevant for operating rates or cost of production when we think about nitrogen fertilizers or sulfur. On the other hand, we are also connected on the downstream with the agricultural markets, which are really driving the strength of our demand. So when I think about this situation and its relevance to the fertilizer value chain, I think for us it was really like the story of two A's, availability and affordability, because both have been challenged. When we think about availability, you've already referred to it earlier at the beginning of this discussion that about 50% of globally traded sulfur supply has been disrupted because Middle East is a major supply hub for that particular raw material for us. And then on the other hand, if you think about finished fertilizer products like urea, which is a global nitrogen commodity, about 35% of urea is really based in the Middle East region. So for us, of course, it was a significant scale of disruption when we think about the changes in the trade flows, but also some challenges in finding some alternative routes to get that amount of product to the international market that it's needed. But then also on the affordability, I think the challenge that we had also when we reflected on how markets behaved in previous times of crisis in 2022, 2008, was that the grains markets currently are well supplied. The prices of grains, they didn't really move in tandem like we have seen previously. So this created a major challenge of fertilizer affordability for the farmers. So their production economics are really kind of challenged when we think about the farmers' margins. And then we also had a story of 2Ds or 4Ds, however we're going to call it, demand destruction and demand deferral. And then here we really need to dig deeper and understand the situation in any given market, because of course for us what matters is the seasonality, where you are in your seasonality fertilizer procurement or your crop production, but also overall whether you have availability of domestic supply or whether you are entirely exposed to the international markets. We had places like Australia, they rely 100% on urea imports, so they were one of the first to be exposed to the scale of disruption. On the other hand, we had places like Europe, which is part of our northern hemisphere crop production, and they have relatively been less affected initially when the conflict has escalated, simply because they had a big purchasing pre-CBAM, pre-carbon border adjustment mechanism fertilizer procurement wave, so it helped them a little bit with the availability of the product already available to the places where it's needed. And then we have also seen different kind of responses because fertilizer value chain is, in fact, it's quite complex and very interconnected. So when I think about demand destruction, maybe phosphate production is a good example. So we've seen operating rates of phosphate production in places like Morocco, India, US, places really outside of the Middle East, also disrupted simply because they couldn't get enough sulfur. And also initially ammonia, which are the key raw materials for the phosphate production. And when you think about demand deferral, it was really some markets when prices of fertilizers have escalated, and urea has been one of those immediately responding to this supply shortage because it's one of the most liquid commodities when we think about price assessments. Some fertilizer commodities or raw materials, they have taken time a little bit to get to the high levels, but also we have seen then different price volatility depending on the fertilizer or fertilizer raw material. Urea and ammonia are currently on the weak side, bearish sentiment, but sulfur at the same time still is still very firm and very bullish, and these high prices seem to be unsustainable, really.
Yeah, and Martha was talking about the importance of China and the degree to which much lower demand for crude imports out of China has been instrumental. I mean, China in the fertilizer markets has also played a fairly important role. We had restrictions on fertilizer exports as well as refined products exports. Has that or the reversal of that from China played a role also in the the weakening of prices that we've seen over the last month or two.
I mean, you are quite right. China is a very important player in the fertilizer value chain. But again, here, the devil is in the detail, as they say. So we need to look at that on a commodity basis. On the one hand, like phosphate restrictions, when we think about export availability out of China, have already kind of been in place. And of course, this was not helping when production of phosphate fertilizers in Saudi Arabia has been disrupted as a result of the conflict. On the other hand, China is a major buyer of sulfur. So what was happening is that when you think about sulfur, there is also sulfur and sulfuric acid. So China has started introducing protective measures to keep sulfuric acid in the domestic market. So they started introducing new export restrictions when we think about availability of sulfuric acid. But if I shift to urea, for instance, so what was happening like after they have finished their peak domestic season, like at the end of May, they have started kind of relaxing the export availability or restrictions in terms of making that urea available to the international market. And of course, India is one of the largest urea buyers, so like typically procuring urea on a tender basis. So that started helping a little bit shifting their sentiment in the urea markets from bullish to bearish. And China, surprisingly enough, also this year played an interesting role as a kind of swing player or supplier in the ammonia markets. So in the past, China has been more of an importer, but this year they have stepped in and they have started increasing export availability of ammonia, because ammonia in fact is kind of unique. It's not a dry bulk product. You really need to have dedicated infrastructure, dedicated LPG fleet to be able to transport it. So it's not even easy to find alternative routes like you can do for dry bulk products, for example.
Okay.
So China played a role, but depending on the commodity, it varied.
Yeah. Okay. All right. I wonder if we can move on maybe and think a little bit about the mechanics of the reopening of the strait itself. Maybe David, we can talk a little bit about this. Of course, we have to park for a moment the potential that the strait could close once again. Depending what happens in the second half of August, if Iran is insistent on charging tolls or charges to ships coming through, of course, that could reignite the conflict and we could be back to square one again. We don't know. It's not a working assumption that happens, but of course it could. By the same token, we could see a more rapid recovery in flows than the one I showed in my introductory remarks. 80% of flows by the end of the year, fully back to flows in the first quarter of next year. When you look at the sort of gas value chain and what's feasible in terms of returning the amount of LNG that we were formerly getting from the UAE and Qatar, what do you think is feasible in terms of the recovery of supplies there?
So yeah, as you mentioned, the situation is quite fragile. There's still quite a lot of uncertainty around the ramp up. We've seen a number of vessels transit the straits, some of which have turned off their AIS signals, which does show not a huge amount of confidence in the ability or the security of transiting the straits. We have also seen higher loadings and deliveries to Kuwait, which could suggest that there's more volumes moving from stock and being delivered to Kuwait, while Qatar clearly does seem to be readying production. But it really is going to require that transit security in order to really ramp up. I think that when that does take place, that we're looking at a period of around about 2 months really to ramp up all of the capacity. And clearly, there's one of the issues we saw around the Barzan processing plant, like they could encounter upstream issues along the way, which could halt it. I think one of the other factors is that the kind of former Rasgas sites, there's two trains that have been damaged, so that supply that isn't going to come back online. So from the 77 million tons originally, we're looking at a ramp up towards 64 million tons per year equivalent. But we're expecting that that disruption is going to continue into September with the voyage times. Then for buyers that could extend to late September, maybe into early October. But I think on the gas LNG side, we're maybe looking at a slightly faster ramp up, but that transit security is really required in order for that to happen. So that is faster than our original assumption. So we were previously working off expectation that supply would return more kind of rapidly from August onwards. And so, it does mean that, factoring in that additional supply, that quicker ramp up, really sort of starting from the not too distant future, that it kind of, in our expectation, is equivalent LNG supply that would enable additional European stock build from where we were perceiving to be a 74% fill to additional supply that theoretically could enable a fill to just below 80%. Now, that's a very optimistic situation. What we've seen, as I mentioned before, is a recovery in Asian demand, if that was to continue. Also, prices have declined quite considerably. We start getting into the coal switching territory. Our view on coal is that with strong demand globally for coal, also a number of supply constraints, so restrictions from Indonesian output, also Chinese domestic coal production issues, and also some disruptions in South Africa and Colombia, mean that there's maybe limited scope for coal prices to drop lower than around $115 per ton potential. So for some upside from that level. So for TTF prices to drop significantly below 40, we'd really start to get to a position where even if that additional supply was to move to Europe, you'd be at risk of incentivizing additional power sector burn. I think those lower prices would definitely see that the kind of redirection of flows to Asia would continue. And so, this theoretically makes a situation where, from the European perspective, that concern over stock fill, this could help to ease that. But I think that if prices were to decline significantly over the balance of summer, then that still may not happen, and that supply could end up going into other areas than European stocks. So looking ahead, we really need that supply to come back online for this winter. In our view, Europe's still going to enter the winter with record low stocks, and it's going to need record high LNG receipts in order to balance, absent a very mild winter. So we're still in that situation if we need supply to return. I'd say that the change over the past month has probably meant that we have avoided a situation where prices need to escalate considerably, which was our view if the disruption was to continue. That may be limited scope. There's plenty of avenue for prices to fall, plenty of avenues for that additional supply.
Okay, all right. Martha, we've already sketched out your working assumption for the recovery in oil flows through the strait. How is it looking from an oil perspective in terms of what's coming out now and what we should expect between now, let's say, and the end of the year? Obviously, we're parking for a moment the risk that we could see a complete closure once again. Can't completely discount that, but how is the market, the crude market, looking for the balance of the year?
Well, yes, versus what we showed at the beginning, the assumption of 80% by the end of the year. Actually, the data for late June and early July actually show a more optimistic picture than our working assumption. So we have a UAE exporting record high volumes, so not only pre-war volumes, but record high, and also Kuwait saying that they are pumping at around 2 million barrels per day, which is something we were sort of expecting them to only be able to achieve in September. So if we take these data points at face value, it actually seems like it's going much better than the working assumption. Having said that, there are certain caveats. The key one being that there are vessels going in the Gulf. That's for sure. There is an increase in the number of vessels, in the number of tankers going in, but we are not yet so sure that this is sustainable. A lot of the activity is actually STS, ship-to-ship transfers by a state-owned or state-chartered vessels. So we have ADNOC, Aramco, and the Kuwaitis having their own vessels and, tanker entities or chartered vessels. So a lot of that activity is the STS volumes going out into the Gulf of Oman and transferring volumes there. And we've also had certain ship owners that have demonstrated a risk tolerance to go in. But in order for volumes to go fully back to where they should be, more ship owners need to build that trust and that confidence. So although the data right now look very good, we still think that it can take much more time to return to fully pre-war levels. Of course, it doesn't have to go 100% to pre-war levels because we do have the bypass pipelines to Fujairah and Yanbu, and the working assumption is that these will be utilized, maybe not 100%, but definitely much more than they were pre-war. Obviously, the Saudis and the Emiratis have the incentive to keep utilizing these. So we don't need to see exactly the tanker entries that we were seeing in January, February, but definitely more than we see right now.
And of course, we could actually see debottlenecking. Well, the Emiratis are building an equivalent 1.5 million barrel a day pipeline for next year, and Yanbu could potentially be debottlenecked to.
Yes,
to
the Saudis have said that they are expanding the east to west pipeline and also the berthing capacity at Yanbu itself, which is actually another critical bottleneck for them. Of course, we've seen Houthi activity potentially restarting. So Yanbu has its own difficulties and issues. Fujairah itself has been obviously attacked at the peak of the hostilities back in March, April. So nothing is 100% safe.
Sure.
But of course, it's much harder to completely deactivate Yanbu and Fujairah as opposed to attacking a vessel from 2 kilometers from your coast. So there is definitely the incentive to try and build that bypass capacity as soon as possible.
Sure.
Yeah.
Okay. And Marina, when you look at fertilizers, what if you had to say what the state of play over the next 6 months through to the end of the year? It's I'm sure product specific. But are there particular pinch points you're looking at for the next 6 months through to the end of the year and into early 27 from the fertilizer complex?
Yeah, for sure. And I would like to link maybe my answer partly to what you said, Marta, on oil and also what David mentioned on LNG and gas. I guess overall, within fertilizer value chain, indeed, we are looking at the gradual resumption of the product availability out of the Middle East. It may take between 3 to 6 months or even longer, depending again on the commodity. In some cases, even with the resumption of the availability out of the Middle East, some markets like sulfur are still structurally in deficit and they are short simply because, unfortunately, there are various other export restrictions in place when we think about places like Russia and Kazakhstan, which have, especially Kazakhstan, has been very recent and unexpected for us. But thinking about also, just to resonate a little bit and connect our value chain to natural gas, of course, the normalization of natural gas, both availability and cost, will be very helpful, especially for the nitrogen production, because when we think about gas, it's the main raw material for nitrogen fertilizers and ammonia. So the gas accounts for between like 70 to 80% of the overall nitrogen production economics. So of course it's quite critical, and especially in regions like Europe, because you were mentioning like the underground storage levels there. So, and Europe is sitting at the high end of the industry cost curve when you think about nitrogen global production economics. So normalization of gas prices will help for when we think about operating rates in high cost locations like Europe on the one hand. On the other hand, also availability of LNG will support operating rates in places like India, Pakistan, Bangladesh, because especially in the first months since the crisis has unveiled, we had disruptions of operating urea rates in those different countries that rely on imported LNG to be able to run their nitrogen facilities. But it was interesting what you've mentioned, Martha, regarding some risk tolerance, I believe you've mentioned, and concerns around kind of ships or ship-to-ship transfer options that you are noticing on the crude side. There was actually a very large fertilizer industry event last week in Monaco, and what we were hearing, I guess, from the delegates when we were discussing, is the focus now is shifting, not so much calculating, okay, how many ships are able to come out of the Strait of Hormuz. We do see like the ships are moving, taking the product out, but it's more really who has the risk appetite to bring their ships in, still having this kind of ultimately like uncertainty that whilst you're getting into the port of loading, taking time to load your vessel with the new products, making sure that operating rates are running fine without any disruptions, and then getting to the Strait, that risk appetite risk actually to get stuck again in that region. So that's really most important, and therefore obviously concerns for us are now shifting even like to the next season when we think about to 2027, when we think about this fertilizer availability and still kind of even affordability. But in the immediate term, of course, it will depend also on this risk appetite from the ship owners, because not all fertilizer kind of voyages or volumes are able to kind of benefit from actually producing companies who are owners of their own fleets, like you have in crude, the instances you've provided.
Okay. All right. But before we finish, I'd like to ask each of you in turn, if you had to say the phrase game changer is overused in these sort of crises, but if you had to think of a couple of things structurally that might change in your markets as a result of this crisis, and I'm thinking more of a sort of 3 to 5 year time horizon. Anything that springs to mind, David, in terms of the gas market, that any lasting structural changes you think?
So with the LNG wave that you mentioned at the start, alongside the US and a number of other locations, Qatar is going to be a big part of that. So clearly the ability to be able to one, finish those projects and get them over the line and start exporting volumes, to be able to, for those volumes to safely transit the strait, is something that's going to be very important, in the next couple of years, if we are to see the huge increase in supply that we're expecting. But I think from the Qatari side, one of the issues that's going to bring is that there's a lot of that supply that's uncontracted at this point. And that may well be more difficult. Like we've seen more US projects receive like offtake agreements, in recent months, and there's a lot of volume that's set to come out of Qatar. They may find it more difficult. They may have to, if there is a situation of paying tolls, they may have to kind of be the ones that take that on. But what that could then mean is, if there's more uncontracted supply, Europe probably becomes a destination for a greater proportion of that. If they're looking for somewhere to place it. I think on the other side, and maybe could be also supporting that, is that we've now gone from the Russia-Ukraine crisis to the US-Iran crisis. And over prior to that, we saw steady increases in demand for LNG globally. And we've just repeatedly had years where we've had to shut off demand. Then we've had an opportunity where that demand could return, and then we shut it off again. And so it's been very, very stop-start. So as we get into a position of this additional supply ramping up, then there's not necessarily this kind of incremental, natural demand that's been evolving that covers more kind of industrial, commercial areas. And so you've got the potential where, okay, a lot of it could find a home in European storage for a time. But it also increases that potential where you have to find a home for it, with the assets that exist at present. So you could see much more fierce competition with coal across Asia. But then on the other side of that, so in addition to Qatar, a lot of supply is coming from the US. And if we get to a position where more and more sign up takes place, more facilities get the go ahead by the end of the decade, again, you have a risk of, is there a point at which you could maybe not sustain, but have periods where that tightens the US market? And so do we get a situation where for demand, the price, to stimulate the demand, it needs to be a very low price, but it tightens the point of the kind of marginal cost producer of LNG, and it does lead to potential for a bit more of a convergence, potentially in the coming years, where you've sort of stifled that demand and you're bringing on a lot of supply from one location. Mm-hmm. I think elsewhere it does also highlight that risk of relying on one nation for your supply. So potential for diversified supply, clearly from Europe perspective, we've been relying quite heavily on the US and probably will do. There's a lot of flexibility with that supply, but it does also highlight the risk around relying on one area for supply. Europe's clearly switched from Russia to US LNG, and then the rest of the world's relying on Qatar, and that's been shut. And so diversification
supply has certainly moved up the agenda, I think. Okay. Marina, anything structural on the fertilizer side you think that will come out of this crisis? What are the...
Yeah, I guess one of the interesting things we have noticed already is maybe I will use sulfur again because it has been by far the most disrupted fertilizer commodity or raw material within fertilizer value chain. What we have started seeing is that there is now a bit of focus on looking at alternative production routes or alternative technologies. Basically, the key question for many, let's say, producers of phosphate fertilizers or sulfur-containing fertilizers or even metals for that matter, when we think about nickel-driven demand in Indonesia, is really like, where can I get my sulfur? Not only how much it's going to cost me, because currently it's still over $1,000 per ton, but actually where am I going to get it? So if I'm thinking about like a short to medium term perspective, and we are starting to see now this the interest into various kind of alternative options available to you. On the one hand, like phosphogypsum has emerged as a potential way to recover sulfuric acid through kind of phosphogypsum management, which typically has been considered as a byproduct or waste product previously in the phosphate production, but not anymore. It's becoming like, it's getting like basically a new kind of perspective when we think about availability of raw materials within a fertilizer value chain. Maybe another one in the nitrogen that is worth mentioning is that, of course, this crisis has exposed the fragility of the fossil-based fertilizer production. As I was mentioning, gas availability and cost is extremely important for us, but at the same time also we are already monitoring a lot of different green ammonia project announcements, and green ammonia ultimately kind of gives you an alternative like a source. When we think about diversification, David, that you also mentioned in gas side of things, diversification of competitive landscape, moving it a little bit just from purely fossil based towards renewable based sources, because you would need to use a different process, electrolysis, and your main raw materials will be wind and solar and water to produce that green based fertilizer production. But these are more kind of not immediate short term available, but these are more kind of medium term, potentially game changing kind of alternative solutions. And of course, like anything that has to do with investing into infrastructure, making sure that if you're inside of the Strait of Hormuz, what are your alternative sources actually to be able to continue to have some kind of contingency planning to be able to get that product if, let's say, to market.
Absolutely. Last but not least, Martha,
Yes,
on the oil side, thinking 3 to 5 years ahead.
Lots of structural adjustments can take place across supply, demand, and pricing. First, on the security of supply side, obviously bypass pipelines will be expanded, more will be built, potentially all the way from Kuwait Iraq potentially harder, and it will take more time, but I think Iraq will also definitely build something or expand alternatives. Stock building of strategic reserves by countries that had a very small one, like India, and they've already been saying that they will expand it substantially, or countries like we've heard Pakistan, Australia, New Zealand saying that they will now obviously create a strategic reserve of their own. And also in combination, the Middle East Gulf countries probably also stockpiling their own crude overseas. In Japan, in South Korea, they already do, with different arrangements with the government or companies. So that will probably increase, and they might do it overseas in places like China and India more, or on the west of Suez side, more storage in Sidi Kerir or ARA. And then, of course, also private companies thinking whether to invest not in the Middle East anymore that much, but in areas where you don't have a physical bottleneck like the Strait of Hormuz. So West Africa, Latin America will definitely see a boost in exploration and production. And then on the demand side, I mean, the price spike obviously has already evaporated largely, but we have seen indications of EV sales rising in Southeast Asia, in Africa. In China, it was already happening. So I don't think it really accelerated by the war, but it just gave them the confidence that they are going in the right direction with electrifying both the passenger fleet and the heavy truck fleet. Also biofuel mandates. We've seen India, Indonesia, other countries as a response to the war saying that they will increase biofuel mandates or bring the timeline forward by a substantial amount. So there will be demand destruction in the longer term. And then third, on the pricing side, with what happened with Dubai and Murban prices, especially back in April, in March and April, there was a realization that these benchmarks are vulnerable to disruption. They were dislocated, especially Dubai back in the first month in March, saw a very big dislocation. East of Suez refiners were very unhappy with how this played out. And there's been discussion about how OSPs will be set from now on by Saudi Aramco, by ADNOC. ADNOC has already indicated that they will probably shift setting their OSPs for the secondary grades versus Dubai as opposed to their own Murban crude. And then a lot of discussion potentially of a delivered benchmark being created that would price Middle East Gulf barrels on a delivered basis somewhere in Asia, whether that will be Singapore or China or India or a combination of the three. We don't know yet, of course. It's still evolving, but I do see a high likelihood of some form of new benchmark pricing emerging. Soon.
Great. Well, an awful lot to digest there. All that remains for me to do is to thank Martha and Marina and David. Thank you very much for your contributions. Keep an eye out on argusmedia.com for more analysis on the ramifications of the Strait of Hormuz crisis. Thanks for your attention, and bye for now.